So welcome, welcome, welcome. Wonderful to have you here for our official Manhattan launch, which we are really, really excited about. I know we did a soft launch with the whole London bonanza, but one of the things that Solon and I wanted to do was to specifically focus today just on Manhattan, just on the opportunity. And when I look at this iconic skyline, it still amazes me that I was able to invest in this the best part of 18 months ago, and I've now got my second opportunity to invest in the skyline. Before we go any further, I just wanted to let you know that we won't be providing any financial advice. We will be trying to give you insights based on our knowledge, our due diligence, and everything else. But at the end of the day, please read all the documents and make the decision based on what works best for you. We also, live in crazy times between the Ukraine war, inflation, interest rates, fuel prices, stock market all over the place, load shedding, Israeli conflict, Trump's attempted assassination, Labour, winning by record margins in England, the GNU, Biden quitting, Trump's landslide, his inauguration, now the tariffs and land policy. And it's interesting, Saul and I laugh even when I do this because I almost have to keep this up weekly because there's like another dramatic thing that literally and I feel out of date, like it's not even a week or two, and I could probably chuck in a few more headlines here. But in simple terms, whether you listen to Ray Dalio or almost anyone, they say, look, the way to get around this uncertainty is through diversification across countries, currencies, assets, partners, and time. And it's all about ultimately building your passive income, protecting your portfolio, and also growing it. So I just wanted to remind you of the 4 key elements to passive income. The first one is partners. You've got to have great partners. And I'm a huge amount of gratitude to you, Solon, not only for the partners you bring, but also just for being here. And, we really value the partnership with Calio Private Equity. The next is you have to have access to opportunities. We're going to go through an opportunity now, a deal that people would just never have access to unless they, were through an ecosystem like this where we're collaborating together. The third is that you need the right information. And that's the whole purpose of this webinar today, to try and give you access to the right information, the right partners, and access to deals. And then finally, you need diversification. And if you put all of that together, it's all about getting paid, which is the ultimate objective of why most investors invest. So without further ado, I want to pivot straight over to the Manhattan launch. And what Solon and I discussed was that the easiest and best way to do this would be literally to log in on the platform and to do it live for people. So I'm going to go in. I'm literally going to sign in here, and everyone can see me doing this live for you. So what you've basically got here now is you've got 3 different opportunities. So you can see the Catherine Street debt option, you've got the Catherine Street equity option, and you've got the Catherine Street blend option. So the debt option is a pure debt option. The equity option is an equity option, and then the debt equity blend is a mixture of the two. Now, my recommendation, Selwyn, is why don't we go through the brochure for the debt option, just because it's the first one. And we'll go through the brochure, because obviously the 90% of the deal is the same deal. It's just the different investment option. So what I'd suggest we do is let's get started with the debt option. And if you go into any of the 3, and you literally go down here and you can download the document. So I'm just downloading it live for you. You can see that I've opened it up here. So what I'd like to do is I'm going to go through the brochure with Selwyn. We're going to talk through the different pros and cons of this deal and what you need to know about it. And then at the end, we'll summarize it by explaining what is the difference between the debt, the equity, and the blend. Are you happy with that as well, Selwyn? You happy with that process?
Yes. Very much so. Thanks, Scott. Let's go for it.
And if anyone's got any questions, chuck them in the chat box for me. Always nice to see what people want to know. And then I'll deal with them at the end, or if they're relevant, I'll deal with them straight away. Okay, so the first thing that I think is important when one's looking at this is that whenever you look at the brochure, you'll see that it's explained right up front in terms of what it is that you're looking at. And obviously, each one of these is different. But let's start with the deal overview. And I think what's really useful here is what you've got in the project timeline down the bottom here, which sort of breaks down the different stages. So you've got the pre guys. I need to be rude. Just 2 seconds. Starwin, just talk quickly. Actually, I'll leave the screen live. Why don't you give us the overview quickly of the deal overview, and then I'll come back to talk about this project timeline.
So Scott, I mean, as many of your investors would know, this is a relatively unique opportunity to invest in Manhattan property. So there's St. Joseph's Church located in the corner of Catherine Street and Monroe, in the Two Bridges district in Manhattan. The Two Bridges is the area that's bounded by the Manhattan and Brooklyn bridges. And for people who know Manhattan, it's towards the bottom, as you look at Manhattan, on the east. So where Wall Street is on the west, in that part of Manhattan, this is on the east. And the project is a refurbishment of what was a Catholic church and convent into a residential and commercial development, mostly residential. And in our write-up, we say 42 apartments. Recent design changes make that more like 38. And it's still subject to some changes, although I think that 38 is going to be the final number. And then there will be commercial space in the basement, most likely taken up by a spa operator who's already in advanced discussions. But it's a very interesting project just as an architectural or development project, moving from what has been a historical church and convent to a residential commercial mixed-use development. And as I'll explain later, as we go through, Scott, that actually has positive, besides for its uniqueness, it has positive financial implications for investors.
Yeah, the one thing that it's so interesting, Sol, and you and I have done this so many times that I actually jumped there without going into the details. And what I thought was fairly relevant was actually just to introduce yourself. And I'm sorry, I've done this so many times, I've bounced straight through that. So just on the assumption that someone didn't know who you were, let me introduce you properly in terms of that process. So firstly, we've worked for a long time with Calio, and one of the things that Garth Wellman, who was the CEO and co-founder, said, the 1% can pay for advice and get results. We need to support everyone else to get access to the same advice and results. And this is the Calio private equity team, of which Glenn, Selwyn, and Garth are the directors. And specifically, we're dealing with Selwyn now. And Selwyn has a tremendous amount of experience in the private equity space, in the banking space, the institutional banking space, and also in the property sector, not just within regional borders, but within the international borders. So I mean, again, the experience is there. You can go and read if you do want to go into the platform and you want to go here, down the bottom here, you can go and read. We'll talk more about the sponsor, but you can also see all about who Calio is, Calio Private Equity, etc., in terms of that breakdown. So I didn't want to jump too far ahead there in terms of where you were going, Selwyn, but I just realized I'd been quite rude and not even introduced you as to who you were in terms of that process. So let me go back now to the deal, and I'll to this page here. The one thing that I just wanted to point out was two things that Selwyn has alluded to. The one was the location. So you've literally got the New York Stock Exchange down the bottom here at the bottom of Manhattan. This building is located here where the big red dot is. Hopefully it's fairly self-explanatory. Then you can see the bridges that he was referring to. So here the bridges on the one side and then the bridges on the other side. And you can see the location in terms of it. So it's on the east side of Manhattan in terms of where your location is. If you're wanting to look at a picture, this is the external picture of the building that is actually being renovated in terms of that process. And we'll go now, but you can see here the pictures where you got the existing church space and what it looks like now, and then what it's sort of being evolved to in terms of the church conversions. But before we go there, I just wanted to share this one timeline, because when I went through this with my mastermind members, this was very important for them. So you can see here that we originally invested right up front in Q4 of 2023. There was an 18-month acquisition period and pre-development. So that's where you're getting all your planning and everything in place. Then there's going to be a construction period. And you can see that goes right through to the middle of 2027. And then there's a hold period, which is 5 years, any good kind of property investment generally is a 5-year hold, upon which there's the sale of the property. So we're sitting literally at this period here. And again, what Selwyn is referring to is that with this conversion from the church to these residential and commercial, we're literally sitting right at this point. There's going to be a construction period, and then from the middle of 2027 is when they'll lease up the building. Are you happy, Selwyn, for me to move on with regards to this sort of background?
Yeah, just one thing to reassure people. This project timeline has been in place for, as you say, for 1.5 years now, and we're actually on track with this project. So Q1 2025, there's an appointment of a general contractor. There's the planning has evolved, costing has evolved, and starting the construction in Q2 by June, or certainly in June this year is what's being targeted and has always been targeted. So things have actually gone to plan exactly from over the extended period that we've been involved in this project.
Awesome. Well, that's always a very good sign in terms of the process. So anyone can go and download this brochure. So, you can all go and look at these pictures. In terms of the investment option, I want to come back to that because it's different for the 3 different types. So let's talk to these deal highlights firstly. So what we've got is we've got the multifamily dynamic. So what is multifamily? It's where you buy the whole building. So you don't try and buy one apartment. You're investing generally at an institutional level where you're owning the entire building. And maybe someone, if you could just talk to what are these dynamics and why is this an attractive location in terms of multifamily in general?
So there's obviously an attraction to New York itself. New York is a financial center. It's got a great migrant population, people coming in from other parts of the United States and other parts of the world to live and work in New York. And amongst them are some of the highest paid people in the world who live there. There currently are quite strong dynamics in favor of multifamily investment in New York, including a lack of new supply coming on stream. Over the last few years, there hasn't necessarily been a lot of activity, and part of that's driven by changes in tax and just slowdowns over the COVID period, capital shortages historically, and so on. So there are good supply-demand dynamics, and part of those are structural. Just as I said, for New York, there's that structural demand. Over here, it says 70% of New York City residents are renters. In other words, people who aren't buying their own home, they need accommodation in something like a multifamily building. And the vacancy rate is quoted as 1.4. It's been at that kind of level over an extended period in New York City. Again, it's just been a very strong market with not much new supply coming on stream and good pricing support. It is the most expensive city for these kinds of residential rents across the United States and probably by implication in the world. So the basic dynamics in this market are very strong. You can imagine, if you know Manhattan, there isn't really a lot of space to build new buildings. So a lot of the projects that I've seen and been involved in have been in other boroughs of New York. Manhattan itself is quite rare, but obviously it's very attractive from a commuting, convenience, and lifestyle point of view.
Yeah.
So those are the things which I think highlight the dynamics, classic supply demand and kind of structural supply demand features.
I mean, I think if you look here, just to summarize what you've just said there, you've got this economic, so you can see the growth. It's like New York's outperforming the rest of the country's growth. You've also got the 70% of New Yorkers are renters. You've got a vacancy rate of 1.4%, which is very, very low. And then finally, you've got rental rates rising. So you've got a supply and demand impasse. So there's not enough supply coming, and there's enough, there's more demand, which is why rentals are rising. Let's go to the deal specific highlights. And you've already kind of referred to this location. But let's kind of just talk to the 4 points that we've got here.
Yes. We've talked about the location. There's one thing which is mentioned here as a point is the development surge. What's really meant there is a kind of gentrification and redevelopment of the area, making it more attractive for people to live in that area, in the Two Bridges area. And again, there just isn't space in Manhattan for 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 new buildings. So a lot of what you see is kind of redevelopment and uplifting. Um, then the particular entry point that was achieved by the sponsors, they've bought this property at what seems like an incredible discount. So the price per square foot in downtown Manhattan has been in the $800 area, and this property was bought at $255. And I think part of it was the dynamics of the sale. It's a property that's been owned by the Catholic Church. And the Catholic Church is disposing of its property portfolio over time, and it seems to be less commercially minded than other investors might be. So there's a benefit here, and that obviously immediately goes to investors. And then, as I mentioned before, because it's a refurbishment of a historical building, just to be clear, it's not a monument or something that has to be preserved completely. It's a historical building that, if it maintains certain features, gets historical tax credits. So effectively, the government is funding you to develop this. And this dramatically affects the economics of this development. To give you a sense, almost 20% of the funding can be seen as coming from these historical tax credits. So quite an amazing uplift and benefit that investors get from being in this. And then ICAP is another benefit that you get in New York developments, and that's a couple of $1 million benefit. These benefits, the tax incentive benefits, are only really achievable because of the strength of the developer. So those 2 points are like the experienced developer. They've done this kind of thing elsewhere in New York, and they understand the system of applying and designing for and ultimately realizing these kinds of benefits. So that's something to be aware of. The developer Origin company, this is a niche they've identified. They understand the city well. They've done historical projects. They've already appointed a general contractor. That's just happened in the last few weeks. It's a general contractor who they know can meet their kinds of standards. So they're experienced on the leasing side, they're experienced on the design side, they're experienced on the management of planning permissions and historical credits.
And something else that I like here as well, Solon, is if you take any typical building, whether it's Manhattan or London or anywhere else in the world, they tend to be big rectangles, and the buildings are going to be pretty stock standard, in terms of, whereas this has a very unique component to it that,
Yes.
any supply and demand, any economics, it's going to make a difference whether you're a tenant or a buyer one day because of its unique component to it, which is just something that I think is worth mentioning. You can see it again. If people want to know what I'm looking at, you can look at high ceilings, and it's going to have a very unique component to it that you wouldn't get
Yes.
in a normal stock standard, typical new building, basically.
Yeah. People will want to live there. That's the point. You want to have space that's actually going to be appealing to future tenants and users and owners of the building.
So if we go into the economics of the development, and again, I don't expect us to go into kind of line by line. People have the ability
Yes.
to go and read this. You've got all the economics of the development. You can see the sort of the cash flows right through from when the property, the construction's finished, right through to when it's completed. One of the things that I found really interesting here was what you said, where the rents could, what was it, that they could be down 20% on the rent or something? What was it specifically?
Yes. So we'll come to that in the risk section,
Okay.
Scott. But yes, the point there is how much margin for error do we have in this feasibility? And there is roughly 20% reduction in rent would still leave this project as a break-even project. In other words, it serves its debt and just continue operating. And
Yeah.
that includes this debt, by the way, the debt product that you're putting into that we're discussing now.
Is there anything else that you would say is relevant in terms of the income assumptions, etc.?
Yeah. Yeah. So what I'd want to emphasize for people listening is this is not I don't, this is me speaking. I don't think, and I've looked at the numbers and I've interrogated them to an extent. I don't think this is an aggressive underwriting. I mean, Scott, you and I have seen projects where they only work because of high leverage, or they only work because there's an assumption of dramatic growth in rentals or in compression of cap rates and so on. I don't think that in this case that's being put into the model. I think there's a reasonable there are reasonable assumptions and assumptions based on the track record of the market now, without being too aggressive. And there are ranges of outcomes which will allow for the repayment of debt and for a return on equity being achieved. So that's something that's important. And then, and I might emphasize this again, but the way the good returns are achieved in this, partly because of it being a unique product, work having to be done, there's value add which is being put into this. So it's not a bet on the market, a raw bet on the market. There is so it's both a risk and a benefit that there's going to be this value add, um, and also there's a financial structuring benefit that comes from the historical tax credits, which is almost kind of free equity or equity that the government is giving you. So those are things for people to be aware of. Some of these cash flows, when I first saw it, I thought it's a little bit too good to be true for a property deal. We generally don't have these double-digit returns and big internal rates of return. But this in this case, it is sensible. I think the modeling is actually sensible.
Brilliant. So, I mean, that sort of talks to what you've just been through here in terms of the returns. But let's just talk to this sort of exit assumptions and, well, firstly the stabilization and then the exit assumptions.
Yes. So I think again, it's been reasonably conservatively modeled, um, and the exit assumptions are stated there. Uh, 4% rental growth is not aggressive given the history or recent history in New York. And just to give you some sense, in quite a few of the projects that these sponsors have been involved in, they've actually been able to beat their original underwriting. I'm not betting on that happening repeatedly, but it does give you some indication of a kind of conservative mindset that they're going in with. And then what's important for our investors to understand, you've got the construction loan, which will fund roughly just a little bit less than half of the total capital requirement to get the project done. There's the subordinated loan of 12 million, most of which is actually already raised and funded. That has to be repaid. And there, again, aren't necessarily dramatic assumptions about how that would happen in year four, which would be a couple of years of construction and a couple of years of settling. Bless you, Scott. Of kind of settling and stabilizing the project.
Perfect. So I think we want to go on to the next one, which is just around risk and, kind of this, because again, any project has risk. What's more important is to talk about the risk and what has been done to mitigate the risk, or at least be aware of the risk in any project.
Yeah. So I think, your investors, many of your investors have gone into multiple property transactions that understand some of the general risks that a property transaction could have. An offshore transaction has structuring risks, currency risks for investors who are not dollar denominated, and so on. So there are those kinds of risks that are not even mentioned on this page that people should be aware of. But the things that are mentioned here, I'm trying to emphasize things that are specific to this project. So obviously, if there's a benefit in, for example, the historic preservation, there's a risk on how to manage that. And again, this is mitigated largely by the experience of the sponsors and the professional team that they're involved in. But the point here is it's a risk for which you get a benefit. And then management, it's not a construction project that's gonna happen here. So it's not a complete rebuilding or a greenfield development, but it does entail genuine construction work and management of a project. And so again, that means there are cost overrun risks and there's scope management risks and there are professional team risks and contractor risks. I don't want, these are standard things for a developer and project manager to be involved in. But those are things that we specifically say because of the stage in which we're entering the investment. Capital is being raised now. There's discussions with historical tax credit funders and with construction finance providers. So there's a high level of confidence that we'll end within the underwriting parameters with the funders here. So that's the financing side. But again, for the project to work, the debt financing needs to be put in place. One of the great things in New York is you are really in the home of the global home of finance. So there are many niche finances, many specialists who understand the market and understand the risks. And having been a banker myself, if I can digress for a bit, I've been fascinated looking at some of these New York projects. What funders are willing to fund in the United States, and particularly in New York, is very different from what me sitting in a South African bank would be willing to finance in terms of development and construction risk. And I think it's because there's a greater confidence in sponsors and there's a understanding of how the market works, the market dynamics, and there's just a deeper pool of talent and competing funds. So that's just something to be aware of. Financing tends to work quite well. We've had bad financing years historically through the COVID period and immediately after, but generally speaking, this is a very good market in which to be looking for financing. Much better than the kind of South African market or even to some extent the UK market in my experience. And then the market conditions, we've talked quite a bit about this already in terms of the strength of the market, the low vacancy rates, the high demand, the seemingly structural problems there are with meeting that demand with supply. But your point about what does the feasibility bear? And what kind of write-down or drop in rental rates would be needed for the project, the basic dynamics of the project to be challenged, and those are quite serious. Those would be close to 20%, close to 20% drop, and even then you could operate the project and wait for things to recover or for the market cycles to play through. Residential and retail leases. As I said, the retail lease is already far advanced. They're already in discussions for tenant fit outs and so on for the target tenant. So that's already quite advanced. Residential leases, again, these are experienced operators in the market. They've worked with leasing agents. This is a market in which there's a great deal of activity in leasing, and they've got strong relationships there. The uniqueness of the product and the demand in the market should make residential leasing. I hate to say this, but that is not something that I perceive as particularly challenging, just given the market and given the product that they want to produce. But that's a view. And then just managing the property again. There's a lot of property management and working with experienced sponsors who have existing relationships with project management companies, facilities management companies, leasing agents. That does help. So many of the people who will be working on this are people who have an existing relationship and track record that we can rely on as we go on with it.
Well, I mean, it's a good way to segue into the final slide that I think is relevant, which is just, I'd love you just to talk a little bit about the sponsor and then also your relationship to the sponsor, because I think these things are critical in terms of, understanding who a sponsor is and why why you would want to work with them, you know?
So the key operational person here is somebody called Travis Stabler, who was the founder of the Rivington Company, which is the sponsor company. And he's done multiple developments, and this is an area of expertise for him. I mean, he's done over 1 million square feet. It says here 1.5 million square feet of residential projects in New York City. I think he's found a niche for himself, and he is a strong operator. My own relationship to this project is through Duncan Randall, who's mentioned on the right hand side of the page. So Duncan and I have known each other for a very long time, and through him, I've been exposed to these projects and invested in my personal capacity. So Duncan has a strong financial background and deal making background. He's a private equity deal maker who was successful. He built he's one of the founders of Tana Africa, which was and still is the Oppenheimer family vehicle for investing in Africa. And a lot of the feasibilities and kind of rigor and due diligence comes from Duncan, who is very strong at those things. There are other partners who, again, bring different skills and financing capabilities and networks. Alejandra Khan and Alvaro Rincon, that's actually a daughter and father group, and they're a family, a property family who have invested in multiple jurisdictions and have a good track record in doing that.
So let's pivot now to, so firstly, thank you very much for that, Selwyn, because that gives us the overview of everything we need to know. So I think, again, if one looks here, you know, one can go through, you can see the different, you can go read all about it, you can download the documentation, you can look through the risks, et cetera, et cetera. And should you want to invest, you can literally go along, you can go invest in this deal, and you can literally go in, you can get started, you can digitally sign the agreement, and you can go, I agree, and you can go make investment. So I just wanted to show you how easy that was. If we come back to this marketplace and just explaining it, the difference between the three different options, which are critical, is that on the debt option, you're getting a debt return. So that's an income return of 10.35%. You're getting that every year for 4 years. So you can see here the term is 4 years. So if you put your money in now, you're getting paid an income return of north of 10%. It's paid out every 6 months. So if you put your money in now, it would effectively be paid out at the end of this year. Is that correct? That's my understanding. Because it's every half.
End of June. Yeah. Every 6 months is so. People who've been invested already would have received funds from January, and then they will. I think that the correct thing for somebody who's investing now is that they would receive funds in June.
Okay.
Either June or December, but I think it would be June. As soon as June, you'd receive.
Okay, but I mean the point being is that you will
or early July. Sorry, early July.
It'll still be calculated. It's just it's in the middle of the year and the end of the year is when they actually make the payment to the distributions. So that's on the one side of the fence. That's the one side where it's just purely debt in terms of. Then on the right hand side, you've got an equity option. So this is where it's you're investing as an equity partner in the deal. And remembering that for the first up until the mid 2027, so basically for the next plus minus 2.5 years, the building is being built, then it's being leased up. And so once it's leased up, you can actually earn an income return on your asset because obviously the rents, both the residential and the commercial, will be paying. So you can see here that you've got nice capital uplift. In fact, you can see a target IRR of 22.5%. So that's year on year. And then you do actually get a cash on cash return. But I do want to make sure that everyone understands that there's a caveat here. It only starts in the middle to end of 2027. Obviously, once the buildings are leased up and it can pay the income. So please, for the next 2 to 2.5 years, there won't be any income. It'll purely be capital growth while the project's being built, and then you'll get your income. And the total term of the investment is between 7 to 8 years. So again, remember always with any development, there's a target. The target is to have it leased up within a certain time, to have it sold off with 5 years after that. In terms of, so that'll be equity. You'll effectively be a shareholder in the project, sitting alongside the developer, as an example. And then the blend is a mix of the two. So a blend is if you put in $1,000, and I'm just using a simple round number, $500 would go towards debt, $500 would go towards equity. And so you get the benefits of debt and you get the benefits of equity. And obviously, from a time frame perspective, 50% of your investment would be on a 4-year time frame, and 50% of your investment would be on a 7 to 8 year time frame. You can see obviously that the target, and the fact that the target return would be slightly lower, because obviously you've got a blend between the debt and equity, and the cash on cash, remembering that the cash on cash would be over the full period, would be slightly lower than the debt option, because you've got the blend across both sides. So just in terms of your sort of thoughts, and if I share my screen again, the benefits of the pros and kind of cons, if you would call it that, of the debt. Everything in life always has a pro and a con. So what would you say are the pros and cons to the debt, the pros and cons to the equity, and the pros and cons to the blend?
Obviously, it depends on the position of individual investors and what their needs are and their risk tolerances and interests are. So the debt option obviously gives you, it's still risky. I mean, you're getting a fantastic interest rate in dollar terms, so you've got to understand that there's a reward for taking something on and being locked in for a few years, but it's fine, it's timed, and they're regular cash flows. That's the benefit of debt generally. Adding the equity, and I'm going to move from the debt to the blend to the equity. I'm going to do it that way. So moving up the risk scale and the return scale.
We'll go to the blend. So
adding the equity,
yeah.
So adding the equity, some of your capital will be in for longer. So the debt will be repaid. That's half of your money. That's anticipated a 50-50 blend. That'll be repaid either in 3 or 4 years. The debt term is set at 3, extendable to 4. So I'm encouraging people to think of it as a 4-year horizon. So half of your capital will come back. You will receive interest from day one. Obviously, as you've explained, Scott, it's less, that interest, because initially the equity is being used to build and not immediately earning income from the underlying rentals of the building. But what's nice in that blend is you have that continuous income, but you also have a share of that upside. And so I've been quite a few investors who are attracted by that combination of things, where I can still get that fantastic return, but I also have that income starting from day one. And then the equity is for investors who want to really take a strong view on this development, and there the returns are really excellent. From a property perspective, if you are somebody who has a portfolio, doesn't require the income, and wants to take a long-term view, the kinds of projected returns that are being presented here are quite remarkable for a property investment. So that makes it kind of unique. It is a little bit rare to have all of these options. Normally, you don't get a debt option or a blend option. So that's just something to be aware of. Normally, you'd only have this equity option, and we would be saying this is a fantastic opportunity. For the next couple of years, there won't be a return, but then after that, there'll be it's projected to be an income stream, because that's how the project is structured.
Yeah. So if we go to just summarize what you said there, and I think one of the things that I think is important in terms of what you just said there, Selwyn, also, is that if we go to this opportunity, and I've shown people where you can find the 3 different options, and I'm going to put up a poll now, but basically people, can fill in the survey, fill in the poll. If you're interested in doing less than $50,000 investment, the recommendation is to go to Wealth Migrate. If you're looking to do more than $50,000 investment, the recommendation is to go to Private Wealth Global, where there's a 50% discount on any fees. In terms of the timing, again, when the allocation is taken. So, and we've been through the timing, but I think this is quite important. I know that there's a lot of pressure from the team in New York, in Manhattan, because we're just a small suckerfish on a much bigger whale. And again, people have said, oh well, when will this be available? Till it's not. There's not a timeline. It's how quickly the allocation is getting filled up. And so from our perspective, please don't wait around. If you're interested, I know that when we did this in November, December of 2023, we had an investor that moved $50,000. By the time it landed, they were full, and they were like, "Look, sorry, we can't take it." So the timing is quite important in terms of the distributions. As I said to you. Oops, sorry, I didn't mean to have London there. Let me just get rid of London. In terms of that, and you basically got the New York ones. It depends on whether you take the debt or the equity in terms of that process, but you can see the breakdown between June 2025 and Jan 2026, which is what Selwyn has already mentioned. And then on the exit, if you're taking the debt, you're looking in sort of December 2029, and if you're taking the equity, you're seeing December 2032, and obviously if you take the blend, it's somewhere in the middle. So I'm going to stop. Well, I won't stop sharing, but I want to just put up the poll. So, Selwyn, what I'd love you to do is just talk a little bit to that time pressure that I've just mentioned, because this is not a sales pitch. This is if people want to participate, they really need to kind of make things happen, because I know particularly some of them, including the debt option, is almost full already.
Yes. So Scott, you'll know I'm placing your team under pressure as well to come back to me on where they stand, or where your investors stand on the capital raise. But yeah, this is a live capital raise. Multiple investors are already in, and others are looking at it very closely. And over time, the capacity has reduced. So again, this is not a sales pitch. I fully believe that they will fill what remains quite quickly. So yeah, I think investors need to start making their decisions now, and hopefully make their commitments now. Then what I will do is lock in those commitments and ensure that there is capacity for us. So I have to admit that I'm quite agitated. I just want us to finalize things, finalize numbers, finalize the distribution between debt and equity, and then we can hopefully find space for all the wealth migrate investors.
Perfect.
But yeah,
Yep.
and just yeah, I mean the actual deployment of funds into the construction is also already starting. There's some preliminary works, professional work that's been done, and so on. So it's they're quite happy to take in funds now, and then the interest clock. That's another element for people to be aware of. The sooner that we can transfer funds, the sooner the interest clock will start ticking for those people who are in the debt or blend.
Yeah, which I think is really important, because sometimes people make investments and kind of be waiting for a project to start. Whereas here, the moment the capital is deployed, you're actually starting to earn an income, which is important. Another question that comes up, and Selwyn, you and I were chatting about this before we went live, is that Mr. Trump has been causing a little bit of how do I say this politically correctly? He's been making some interesting waves around the world, and obviously people are thinking, what does this mean for America and everything else? I will give a caveat even before I answer this question. If Selwyn or I had a crystal ball, then that would be fantastic, because we are sort of in unprecedented waters. But what is your thoughts on this tariff and potential kind of economic impacts, and specifically with regards to this project, Selwyn?
Yeah, so I think one of the advantages of this project is domestic American project. It's not relying on the American market, or exports or imports into or from America. So I think that's quite important. I don't think anyone anticipates America. Obviously, the project of Trump is to make America great again. So promoting domestic investment, promoting domestic economic activity. So various things which would be tailwinds for this kind of investment are on the agenda for him. So I think that's something just to be aware of. And speaking personally, I feel much safer with domestic American investments than I do with investments that are reliant on the American market but not located there, or not somehow very much locally American. So that is one sense in which this is I think a relatively attractive investment opportunity amongst those that you might see. And yeah, like you, Scott. I just want to say I don't have a crystal ball. I'm not sure how the markets are going to evolve. What does seem to be the case is that the kind of broader markets are going to be facing volatility as long as Mr. Trump is around and pushing buttons and signing documents. So that's just something. This is a different category of investment. To me, it's something which is a little bit more traditional. But yeah, neither of us are advisors to any of the people who are listening to us. Everybody needs to assess their own portfolio, but you always emphasize diversification. One of the things that's come home to me just watching what's going on is part of the diversification is certainly into America, which is a giant economy and is able to do things that other economies are not.
Yeah.
No other world leader could do what the President of the United States has done over the last week and ruffle as many feathers and cause as much consternation. And that to me just emphasizes the power of America and hence the need for us to be invested in that economy as diversified investors.
I think one other thing to add to that, with all the sort of the markets, I woke up on Monday morning and someone was like, "Oh, the markets are down 6%, etc." That's one of the reasons why, and a lot of people have seen the research that I've shown. The top 30,000 wealthiest people in the world, more than 50% of their portfolios are moved and are moving to alternative assets because it's not so tied to sentiment and markets up and down, etc. And I think I'm just backing up what you said, Selwyn, that more traditional investment, kind of steady Eddie, and what you're looking at is not as, it doesn't fluctuate up and down as much based on sentiment and more based on the fundamentals, which is why we spent so long in this last nearly hour going through those fundamentals.
Yes, exactly right, Scott. That's exactly right. And then just more generally, and again, this is something that you've been very involved in, private assets. So the public markets feel the brunt immediately, and people exit those markets. And there's the volatility that comes out of being sentiment driven can be seen in the public markets. Looking at private assets, which is where you and I focus, is actually something that the biggest investors in the world have moved to quite explicitly: endowments, sovereign wealth funds, and so on.
Perfect. So let's answer some of the questions that have come up here. Craig said, why is the minimum investment set at 1,000 for the equity option? Can it be lowered? Craig, it's actually meant to be 1,000 for all of them. I just asked for it to be lowered because I was doing a demonstration for the How to Get Paid presentation tonight, actually. So it's a bit of a fluke in terms of that process. So the answer is the minimum investment is meant to be 1,000 for all three options. Jenny, so take advantage of what you've got. Jenny, in the debt option, when we get an annual return statement from you, will it say debt repayment? If so, there's no tax payable on it. If so, what I think you're asking there, Jenny, is the original capital going in will always show return of capital if that's what you're asking, and then on the interest component there'll be the interest amount. I think that's what you're saying, but I just want to make sure I'm helping there. Archie said, "Hey, Scott and Selwyn, I just want to clarify that with a 50-50 option, you would receive a 6-monthly distribution starting in 2025 on the debt portion at 10.35%. So yes, on the debt portion, the return will be 10.35%. And if you're deploying it now, it'll be before that window of, let's call it June 2025, which means the payment would arrive in your wallet in July 2025, roughly." You happy with that, Selwyn?
Yes, I think that's correct.
Just to clarify, it would be on the 50% that's in the debt portion. The equity portion would only start earning an income once the building is leased up. I can't say that enough times. Just in terms of people making sure they hear me on that. Vanessa, please could you explain the equity return and the timeline? I'm not sure I understand the year 2022. Give me an example of $1,000. Okay, so let's go here, Vanessa. So this is what we went through. with some of the mastermind members and wealth hackers. So if I come back to this timeline here, you can see this timeline here. So we're sitting right here. Hopefully you can all see my mouse. On the equity side of things, you're going to put your money in, and there's going to be no income return that's earned for the first 2 to 2.5 years. Once the building is built and it is leased up, so that means that they put tenants into the residential property and they put tenants into the commercial property. And once it's starting to earn a return, then during this yellow period is when you'll actually earn an income return. So you'll get capital growth only between this area in light gray, and then you'll get capital growth and income in the yellow period. Okay, now if you take that total return and you divide it by the number of years, which in simple terms, I could go into much more detail about what IRR is, but in simple terms, IRR is the total return per year, taking account, there's 27 variables, but taking account inflation and time value of money, etc. The return year on year would be 22.5%. So over 8 years, you would put in, if you put in $1,000, over 8 years, roughly, you would get your $1,000 back, plus you would get another plus minus $2,000. So you would get, you'd put $1,000 in, you would get $3,000 out, and that would be a mixture of your capital growth and your income. And I'm just doing simple maths. 22.5% times 4 is roughly 100%, times 8 years is roughly 200%. Hope that helps. Annie, can someone help me move my funds from Wells Fargo to this investment? Annie, I'll take a note of that in terms of the process. There are some constraints, but I'm sure we can help you find a plan. Ilda said, hi, Scott, where do investors from November 2023 stand? Which are the 3 options and the 12 to 18-month investment? How long do we need to be invested for? Okay, so Ilda, this is a great question, and this is for people like you and me that invested originally. So if we invested originally in Q4, so again, back down to here, Q4 of 2023, in the middle of this year is when that money will be repaid to us in terms of that process. Now, we have the first right to roll that over into the new options. And again, someone, please jump at any point if I'm misunderstanding this in terms of that process. What we've said, Ilda, is that we want to hold our position because it's so difficult to get into this opportunity, that we as Wealth Migrate want to hold our position. And if someone wanted to leave, let's just say Ilda wants to leave, she will get returned her capital plus her interest, and then we can allow new investors to participate. But in simple terms, what I'm saying, Ilda, is that if you're an original investor, the timing to get your capital out now will be the middle of this year. And if you want to roll over, we will need the final decisions from everyone before the middle of June, just in terms of that. We, between Selwyn, Paolo, and I, we still just need to understand how that process is going to work. Ideally, we'll do it in an automated way, but either way, we'll make sure that we give investors the option as to which one they want. And please, Selwyn, jump in if there's anything else you want to add to that.
Yeah, Scott, I think it is. Yeah, I think it's a discussion, but I would hope that investors have been happy with returns they've received so far. They want to keep their money in some shape or form in this investment. And so the rollover options I think are very attractive.
Yeah. And I think that's the purpose of this webinar that we've gone through, which was just to explain, firstly, the fundamentals of the deal, who the partner was, and then actually to provide the 3 different options in terms of the debt, the blend, and the equity. I like the way you did that, Selwyn, in terms of the risk profile as well, because obviously if you take it on a sliding scale, debt's here, blend is here, and then equity is on a risk perspective in terms of how someone would do that. Okay. Any other questions from anyone in terms of that process? Let me just go back to this slide here. I do have the poll open, so if you're here, I would strongly recommend that you let us know your thoughts. We would really appreciate it. It's always valuable for us to get feedback from investors in terms of where they're at. So please do me a favor. It'll take you 30 seconds to fill in the poll. And as always, you can go straight to the platform. If your wallet's already funded, you can go straight to the platform and invest like I have already in terms of that process. Archie said, so for new investors, do we need to sit to wait until? No. So we've already got an allocation, Archie. So you can participate right now and you can deploy your capital in terms of that process. Glenda, so if we invested originally, we can simply ask for our funds to be moved across to the new opportunity. Yes, Glenda, that's the process in terms of how that'll work. Catherine, Scott, it would be great to have investment calculators for each option on the page. You are correct, Catherine. And I did explain this in the previous session that we did with the Mastermind and Wealth Hackers. The problem with the investment calculators is they're quite specific. It's a fairly, someone you actually mentioned earlier, a typical property deal is quite simple. You put $100 in, and then there's a time period, it's 5 years, you earn some income, or maybe it's a new development and there's capital growth, and then you exit after 5 years. With our calculators, they've been built in a specific way. It becomes a lot more complicated to do the investment calculator based on all these nuances between the debts, the equity, 4 years, etc. So the team has struggled with that on our investment calculators, but that is why in the brochures, the cash flows are there so that people can actually see them in terms of those returns. But Catherine, I'm fully aware of your question, and it is something the team is working on. But this one's caused a little bit of a nuance, even down to it's in the debt option, it's 3 years, but with the extension for 4 years. And so like at a calculator, do you put it in 3 years, do you put it in 4 years? And the total equity investment is 7 years and 11 months. So someone just in future, can you just make sure that you wrap stuff up and
I'll try and find neat, Scott, I'll try and find neat deals for you.
Yeah.
I'm sorry that
no, it's just from a spreadsheet perspective, it's always easy. But from a tech, they've built a fairly stock standard modeling system, which is what Catherine's asking. So look, I want to kind of keep this unless there's any other questions. So, and I deeply appreciate your time as always. And
Thank you, Scott.
for me, to all the investors, we've had a lot of people who've been online asking questions, so I really value that. If you haven't filled in the poll, please fill in the poll. You can see there that the next steps are fill in the poll, go to the platform. If you're going to invest less than $50,000, you've got Wealth Migrate. If you want to invest 50,000 or more, then Private Wealth Global. It's on the exact same fee structure as what we've agreed with Calio Private Equity. So that makes perfect sense for anyone. The timing, as we said, and once we're actually aiming to do a tranche. So the moment a month closes, we move a tranche of capital so that people can actually earn income on it directly. The distributions we've been through in terms of they half annually, so the middle of the year and the end of the year. And then finally, the exit on the debt is 4 years from now, plus minus. And then the equity component is, or the blend for that matter, is 7.5 to kind of 8 years in terms of that overall process. Final comments from yourself, Selwyn, in terms of just generally to wrap it up from yourself.
Well, Scott, thanks for the time, and thanks for the opportunity to talk to you and to hear what's on the minds of your investors. Yeah, as always, I think it's been an interesting conversation, and hope that many people take up the opportunity of pursuing this investment, which I think is quite a unique and special one. And I say that, obviously I'd say that about anything that I present, but I think of all the things you and I have discussed, this is really different and is something that doesn't come along very often, but because of where it is and how it's been structured and the kind of product that's actually being produced.
Yeah, and I would echo that as well. So when I've been doing this 28 years now, I've been doing American investing since 2010. I've never had a way to get into Manhattan ever, not once. And I have looked at other New York boroughs, like you've said, but also for me to look and see double-digit returns in New York, let alone Manhattan, is unheard of. But why this is an opportunity is because you're getting access to better quality partners at an institutional level that I previously never had an option for. And that's one of the reasons why I deeply appreciate the relationship with Calio Private Equity and thus your relationships with partners like this. And just because it's an available option now doesn't mean there'll be another 3 or 4 coming down the pipeline. In terms of what's happening in Manhattan, you've always got to take market conditions into account and a whole bunch of things. So if it is something of interest to you, then go do your research, take advantage. And unfortunately, it's a bit of a race. And what that means is they're only looking to close in June, but the moment that the capital is full, then that'll be the end of the option, like happened to us already in Q4 of 2023. Thank you everyone for your time, and you've got the next steps if you know what to do. If you want to reach out to one of the team members, you're happy to do that as well, and we're happy to help. Cheers and happy investing. Cheers.